¿Qué tal? Muy buenos.
Good morning, dear attendees. I'm Jessica Roland Peña, and I'm the Director of Microeconomic Studies at CAF, the Development Bank of Latin America and the Caribbean. Welcome to this webinar hosted by FLAR on inflation dynamics in Latin America, achievement risks and policy lessons, and the perspectives from policymakers and chief economists going forward. We have three keynote speakers: Gabriel Cuadra, Deputy Governor at Bank of Mexico; Elias Albagli, Director of the Monetary Policy Division and Chief Economist at the Central Bank of Chile; Juan Jose Ospina, Director of Monetary Policy and Economic Information at Bank of the Republic; and Adrian Armas, Chief Manager of Economic Studies at Central Reserve Bank of Peru; and of course Carlos Giraldo, Director of Economic Studies at FLAR, who is going to be moderating this session. So there will be two individual rounds for questions and answers. Without any further ado, please let us start with Gabriel. Thank you very much, and please go ahead. Good morning, Jessica and Carlos. Thank you very much for having me at this webinar. I would also like to greet all of my colleagues I would like to welcome all those joining this webinar. In the case of Mexico, and during this first part of today's webinar, I would like to touch upon those factors that have had an impact on inflation in Mexico as of late. In this regard, I would like to underscore that in Mexico, this year we have been facing some supply shocks, relative price changes, special tax increases, tariff rises. We have also experienced significant agricultural product price increases, and we have also been affected by international oil prices, even though some domestic policies have helped us to tame inflation as a result of these developments. So we have been able to control these supply side shocks. Most importantly, we have not been experiencing any demand pressures. We have some supply shocks and pressure, however, and therefore I would like to focus on the tax changes that have been implemented. On the one hand, special taxes levied on special products and tariffs imposed on those products coming from countries with which Mexico does not have any trade agreements in place. So first off, special taxes which were levied on tobacco and soft drinks were limited over time. In the case of tariffs, up until now, we have not observed any pass-through to prices. Against this landscape, I would like to say that there's no evidence concerning the effects that these shocks could have had. From a theoretical perspective, there have been some tax adjustments, as a result of which, well, there have been adjustments on some general prices. Monthly inflation has been rising. on a temporary basis during the time when these taxes were levied, and this had an impact on annual inflation rates, and this is something that we can see after 12 months. Let me now focus on these special taxes. This is not the first time that Mexico levies special taxes. This already happened back in 2014 when levies were imposed on soft drinks. There were some adjustments as a result of inflation over the past 2 years, and now special taxes have also been adjusted further in the case of soft drinks, as well as regarding all those drinks that use products which are different from sugar as sweeteners. Let me now refer to the impact that this has all had on inflation. And let me talk about a contrafactual strategy. Synthetic controls have been used in order to replicate the dynamics of the prices that have been directly hit or affected by these taxes. As you can see on the first chart, we have fortnight inflation shown in the red line, which rose early this year. Subsequently, it fell, and right now it equates to the contrafactual trajectory shown in the blue line. As for annual variations concerning good staples or foodstuffs, we can see a baseline arithmetic effect of annual inflation in the case of foodstuffs if we compare this with the contrafactual trajectory. In the absence of these taxes, we would have observed inflation on foodstuffs to be below the values reached at the end of 2025. The key message, therefore, is that special taxes had a limited impact or effect. Now, let me refer to tariffs. First off, I would like to say that these tariffs were imposed to those products coming from countries with which we do not have trade agreements in place, particularly those coming from China. In the case of those manufacturing sectors with a greater share of imports, in this case, tariff increases were lower compared to those industry sectors where their share is greater. Therefore, these also had a limited impact on prices. One could assume that non-foodstuffs were the products with the greatest impact. Well, this is monthly performance of non-foodstuffs during the first part of 2026. These monthly variations performed in line with historical patterns, showing monthly shifts which were similar to the ones reported early this year, as well as sometimes they were below historical patterns. We therefore conclude that for the time being, tariffs had no impact on the tariffs applied to non-foodstuffs, and therefore the pass-through would be limited in this case as well. Now, exporting companies might be absorbing the impact of these tariffs through their margins in order not to lose market share. So the key message is that in Mexico, we are not experiencing demand pressures. We have been faced by supply shocks, some relative price shifts, and no second-order changes have occurred in connection with these shocks. Thank you very much. Thank you, Gabriel. Now, we are going to give the floor to Elias. Elias, you have 6 minutes in order to answer the first question of this round. Thank you very much. Jessica? I would like to go back in time a little bit, if you would allow me, in order to dovetail this with the next question concerning what the outlook is going forward. After the COVID pandemic, both in Chile and in the world at large, we experienced some shocks and policy reactions. The COVID shock had a particular strong impact on supply, leading to non-monetary, counter-cyclical and fiscal policy response. Very often, however, that response was too exaggerated. This was a non-focused policy. That is, it was not focused on the households that were hit particularly hard. However, it was focused on the economy at large. In Chile, this accounted for 30 basis points of liquidity over GDP. That is to say, GDP was affected with a drop of 30%. In the case of Chile, this was due to internal or domestic pressure. Next, we have the monetary policy response or reaction, which started back in 2021 when the central bank pushed rates up. Inflation, therefore, did not reach high levels, peaking only 14%. Another important component of this episode that I would like to mention in connection with the next question as well has to do with inflation expectations. When we were halfway through this inflationary episode, we were affected by the war in Ukraine, which caused inflation to reach the previously mentioned levels. Inflation expectations were unanchored. We established a 2-year horizon for the target inflation. Therefore, we had to apply an anchoring expectation. And that expectation was supposed to be 3%. However, this was disrupted amid this high inflationary scenario. As a result, the Central Bank of Chile had to hike rates to much higher levels than if such expectations had not been de-anchored. And that's why such rates remained high for quite a long period of time. Once inflation began to decline and neared 3% in 2024, we were affected by a supply shock as a result of electricity prices that had lagged behind for some time. This is slightly different from what I have just mentioned. So before we spoke about supply and demand shock. In this case, this episode was due to electricity price surges with no secondary effects. At least we did not anticipate such effects because this affected only electricity prices for households, not for companies. Inflation therefore rose on a staggered basis, but this was a one-off. The central bank reduced the rate of decreases, so rates were cut slowly. But if we price in inflation expectations, we can say that the central bank held the rate steady. That supply shock did not have a consequence on the country's monetary policy or on the economy at large. We were about to strike a break-even situation. The unemployment rate is high, but not as much as one could expect, and we were quite close to the inflation target. But now we are being affected by another episode. Inflation shifted from 2.4 prior to the war to 4%, as it has been reported lately. In closing, let me leave you with some key messages. Whenever we are hit by demand shocks, usually they come hand in hand with supply shocks. In the case of Chile, the demand shock was so high that the monetary policy had to react quickly. The second takeaway message is that when inflation expectations are de-anchored, the central bank has to undertake a very tough task. And I would like to underscore this message because this is going to have an important effect going forward. But I'm going to go back to that afterwards for the second round of questions. Thank you very much, Elias. Very good. We now move on by highlighting the heterogeneity of the narratives from the different regions. Juan Jose, could you please share with us your opinion about how inflation has evolved as of late? You have 6 minutes. Can you see my screen? Asks Juan Jose. Yes, we can. Thank you. Well, thank you for having me. In Colombia, this is a total and baseline inflation after the COVID impact. Inflation began to slide down. So this decline in inflation was slower compared to other countries. And most importantly, just recently, inflation settled at around 5%. Subsequently, it began to rise. And that's why this year this rate is higher. This process, therefore, was slower in Colombia compared to other countries. Let me highlight 2 key factors concerning this slow fall in inflation. On the one hand, salary rises in Colombia. These salaries are quite high. Most workers have been receiving increases above productivity compared to the previous scenario, and therefore this has caused inflation not to go down. And we were also affected by fuel prices that went up by 60% because these grants on fuels were not fiscally sustainable over time. So since 2025, we have observed this inflation rise due to some domestic factors. We have a GDP gap which is positive and has been positive. Domestic demand grew, particularly in 2024 and 2025. We have reported this sustained growth over the past 1 year and a half in excess of 4% and sometimes reaching 5%. We have also observed a slowdown late last year. Afterwards, we can discuss this further. This shows that we have some supply shocks as a result of which this might be considered to be an interim or temporary development. On the other hand, at a local level, our primary fiscal deficit is quite high. This is information reported by the national central government. It's quite high. It has been so for the past 2 years. We are trespassing the tax rules here. And this is not too big over GDP. Nonetheless, this rate has been growing. At a local level, labor costs and salary increases have been quite high. On the left-hand side, you can see the minimum salary increase of 23.7% all in all. But if we take into account non-salaried workers' income, has also grown considerably since 2024, causing an acceleration in the income earned by households. This is all the result of some administrative decisions made back in the day. This is the unemployment rate in Colombia, which is quite high on average. However, compared to our historical levels, we are standing at a low level, and we believe that this trend will continue to decline. Households have been benefited by revenue coming from the coffee, tourism, and remittances sectors. As a result of this, we observe and Colombia peso appreciation tendency or trend. In our case, the war had a positive impact in terms of exchange rate. This also accounts for this chart. On the left-hand side, you can see inflation affecting services and goods. In the case of services, inflation has gone up to 6%, nearing 7%. But in the case of goods, inflation, which is quite linked to exchange rate, has already reached 3%. This is the only basket that is close to 3%. All other services or other products are above 3%. So this is the most important shock. So the 23.7% minimum salary increase has caused all inflation expectations to trigger at the end of 2025, early 2026. So scholars, analysts, and corporates or even inflation analysts, they have all reported the highest increases in history taking place in a single month. Inflation has, or the inflation target that has been set for the past 2 years, between January and March, the governing board has increased the interest rate from 9.25% to 11.25%. As a result of this policy decision, you can see what has happened with inflation expectations. On the left-hand side, you can see the reaction, the positive reaction that took place after the aforementioned increases. These expectations are far from the targets. Analysts who had their expectations anchored at 3% have changed that, and the same happens with corporate owners. And this also happens with the break-even inflation that is already near 6%. All in all, the reaction has been positive as of late. However, this is not fully in line with the targets established by the central bank. And I'm going to stop here. Thank you very much. Juan Jose, we move on. We move on with Adrian Armas, please. Good morning, everybody. Thank you very much for having me. We are going to start with the first slide. Slide number 5. Well, actually, it's slide number 2, please. Thank you. Well, as for the inflation target in Peru, it stands between 1 and 3%. Over the past 9 years, except for the GFC period, this shock was around 2% in terms of supply. Now, in high inflation times, we reached 8.8% in June 2022. That was our peak. Mexico reached a lower level, and by contrast with Chile and Colombia, we had some demand effects that affected inflation. We observed a typical supply shock with relative price increases, and as a result, inflation expectations were also magnified. This is something that we are normally afraid of. The monetary policy rate in our case reached 6.75%. In terms of sequence, as you know, central banks hiked their interest rates timely. In our case, inflation converged with a target, and this has happened since 2024. There was a deviation over a 3-year term. Our mandate is that inflation remains within the target. And whenever there is a shock causing inflation to deviate, the Central Bank of Peru tries to bring inflation to the target within a reasonable timeline or time horizon. So we believe that the measures taken at the time were appropriate. Now we are embarking upon a new period. Up until now, since February, inflation has remained close to the target range. And in the case of Peru, this shock was bigger in the case of supply, as I'm going to show in the next slide. In Peru, inflation stands at 4%. In the case of food and energy, 4.2%. But if we do not take this into account, we're talking about 1.5% if we exclude transportation. If we take into account dispersion factors across the basket for end consumers, we observe that in April, 33% of sectors have a year-on-year inflation about 3%, which is lower than the historical average of 39%. In Peru, the average inflation is 2.9% over the past century. So this shows that up until now, this sharp inflation surge in the Peruvian context has remained limited in some particular sectors. It has the typical characteristics resulting from a supply shock. Let's move on to the next slide. In our case, inflation surged. Why has this happened? This is due to some idiosyncratic issues. We have been affected by the Iran war, like other countries, as well as by the closure of the Strait of Hormuz. 20% of oil and gas supply, internationally speaking, has already been allocated. Now, when this happened, when the outbreak of the war took place in our country, we experienced the Camisea gas interruption, which accounts for 95% of total natural gas in Peru, as well as natural gas for consumption purposes. In addition, the Camisea gas accounts for 55% of total consumption of GLP in Peru, and the remnant, which includes also exports, has been affected by bad weather conditions at sea in Peru. Therefore, in our case, we have observed how this has all amplified prices across fuel sectors. Domestic demand, on the other hand, has been growing dynamically in our case. Electricity generation has also been affected, as a result of which electricity prices went up because of higher diesel prices. This is for the explanation of why, in our case, we reported a higher inflation rate. And I'm going to stop here in order to comply with the time allotted. Thank you very much, because that way we can now move on to the next round, and we are going to talk about the challenges concerning monetary policy. We are going to talk about heterogeneity and the diverse challenges the region is facing. On the one hand, we have some supply-related issues, which sometimes is coupled by strong demand. Some other times, we have issues concerning one-off episodes. So without any further ado, Carlos, let me hand over to you to move on with the discussion. Thank you very much, Jessica. Thank you. And welcome everybody. We are now going to start with the second round of discussion. We are going to take a forward-looking view about inflation for the coming months. We're going to talk about the main risks and challenges, monetary policy challenges against the current global landscape, which is quite complex. To start out, we're going to follow a different order. Now we're going to start with Juan Jose, who is going to continue talking about the current situation in his country, in Colombia. Okay. I would like to share our forecast, the one that we reported in 2025. Minimum salary shocks happened back in 2025. So we thought that inflation was going to hit 3% by late 2027 and to stand at 4.1% in 2026 after a disinflation process, since right now the minimum salary has risen to 6.4%. We expect this to go down as a result of the monetary policy response, which was quite significant. So we expect this to stand at 3.7%. This change was quite significant. You observed analysts' expectations and financial markets' expectations, and business owners also have more or less the same expectations. As for core inflation, in the past, we believed that inflation was going to be 4% this year or 3% by the end of 2027. Now, we believe that this convergence will not be reached, and we observed significant inflation increase, especially in the case of services, where inflation remains sticky. We believe, however, that inflation will go down due to the response coming from the monetary policy. Afterwards, we can elaborate on that further. GDP gap is going to be negative in 2027 thanks to the shocks arising from FX, which we believe might cause some increase in inflation pressures. So expectations are that inflation will be reduced over time as we also strike a balance in terms of the minimum salary increases. This is our GDP growth forecast. 2.4, 2.1% for 2027, with some acceleration into 2027 as a result of positive effects coming from foreign exchange differences. And this is related to some of the shocks we observed in late 2025, and it's also connected to the supply shocks arising from labor costs. In the case of GDP gap, we envisage that it's going to be positive, turning a little bit more negative during this time horizon. In some, GDP gap is positive and inflation is above the target, but we believe that the monetary policy is not causing a trade-off, at least at the starting point. You know that we do not show our monetary policy rate usually, but this is what analysts expected back in January, and after a quick monetary policy response, they expect this rate in 2026. It's slightly higher compared to our forecast in 2026. We believe that analysts will envisage higher salary increases and a lower gap compared to our own estimates. We are worried about the fact that all risks have been estimated with an upward bias, and we believe, however, that inflation and the interest rate will be estimated with a downward bias. My apologies for this crowded slide. These are the inflation, interest rate, growth risks, and in this case, inflation and interest rate plus growth. We are worried about inflation expectation and anchoring, as well as by any long-lasting deviations in terms of inflation or the inflationary shocks that could result in higher interest rates being implemented by the Fed. As for the Middle East conflict, we have a conservative opinion. We do not envisage higher oil and gas prices because we believe that the central government will decide not to raise those prices anymore. However, if the fiscal policy is fragile, eventually that will have an impact on consumer price index. There are also some upward risks affecting transportation prices. In the case of foodstuffs, we have been hit hard by fertilizer price surges. We have also been affected by the El Niño phenomenon, which translated into higher energy prices. And even though this is a supply shock, this would find us with high inflation and with expectations being somehow unanchored. Then we had to decide whether the minimum salary impact over prices might affect us further in 2026, which might push risks up. As for downward risks, we have to wait and see what happens with the war and how things play out. And should there be a fiscal consolidation, this would translate into a downward risk. affecting growth, and this could lead to a fiscal adjustment, but we have not priced this in as part of our forecast. This is the major challenge that we are facing at the central bank. We are navigating the toughest moment since 1999 when we established inflation targeting regime. We want to keep up scheme in order to tame inflation. Right now, we are above the target set. We have been reporting increase in inflation over the past 6 years, and it's going to take us a couple of years to reduce that inflation. We have analyzed different scenarios. For example, we have analyzed the front-loaded and the back-loaded policy respectively. This is faced by many roadblocks. For example, some divergence in terms of the governing board's stance. There are also some issues concerning the strategy and monetary policy targets that could jeopardize the independence of the central bank. And this is also translated into deteriorated public finance. This context, therefore, could lead to an erosion of credibility concerning inflation targets, and eventually could push the inflation rate up. The main challenge, therefore, is to, reach good communication with Congress and with the public at large. Here we have some accountability issues. The bank, therefore, has prepared some answers for the public at large, taking into account that this discussion is not only concerned with economists or analysts. We have tried to come up with an explanation for society at large. The governing board communicated all this to Congress and also carried out some outreach actions in public fora. We tried to answer why we did not want to change the inflation target, and we prepared several charts in order to explain inflation in simple terms, explaining the consequences of monetary policy. What happened is that expectations went up, therefore the monetary policy was eased ex ante, and as a result, the governing body restored the monetary policy stance that it had prior to the expectations shock. Explaining that when you have 200 basis points of interest rates was kind of complicated, and that is, of course, the big challenge that we have ahead. Thank you. Thank you, Juan Jose, for giving us some color on the complexity of the Colombian economy right now in dealing with inflation expectations, taking into account these supply side and demand side shocks, respectively. We also observe some significant effect of these shocks at a domestic level. Let us now move on with Elias. Let's go back to Chile. Elias, I believe that you're going to be showing a couple of slides, right? Yes. Before I do so, let me say that I'm going to share with you the outlook for Chile, but I would like to focus on the international economy, which I find to be more interesting. I think that we should try to find the common denominator between Chile and the international markets. What do we do in Chile? Well, we Chileans show our future monetary policy rate expectations. Could you please confirm whether you can see the slide? So we show what we call a corridor. So you will see plenty of colors and lines here. Let me explain this. The corridor stands between these two thick blue lines. So in March, the central bank kept the rate, but then it announced that we were exposed to plenty of uncertainty and therefore we had to evaluate alternative scenarios. Usually we analyze alternative scenarios which are related to explicit economic trajectories, and that's how the corridor is built. The governing board, therefore, does not report a probable rate trajectory, but rather how we are going to react in the face of this situation. Right at the bottom, you can see a scenario which looks rather bleak and where the global economy might be faced by a sharp slowdown. For example, if there is a tightening of financial conditions due to the worsening of the war, if stock markets drop, that is to say, a crisis scenario. In that case, we would experience short-term inflationary pressure. But in the medium term, we would have a counter-cyclical situation. That is to say, we would level inflation when the situation gets bad. Right above this, we see inflationary pressure coming from the external side, as I mentioned before. However, rather than experiencing a slowdown in the economy, remains resilient and therefore inflationary pressure is eased in the United States or in the Eurozone. As a result, central banks cannot cut interest rates. On the contrary, they have to hike interest rates. This could have implications on the currencies, particularly of emerging economies. In this context, where the economy remains resilient, oil shocks are inflationary ones because these are supply shocks in a highly or in a high demand scenario. Let me share with you some background information. And Carlos, if you would allow me, I'm going to focus on the United States here. If we take a look at financial variables, very often we use semi-structural models in order to tell quantitative stories. And we normally use information from the stock markets, interest rates, or pricing in the defense sector or the energy transition sector. And we do this in order to assign movements of financial variables to a structural scenario. Since the outbreak of the war, the U.S. stock market shrank by 8%, reaching a record low. That has already been reversed, however. This graph is a little bit old, but right now the stock markets are at a much higher level. We have two opposing forces here. The market expects the Fed not to cut rates any further. So as shown in the purple bars. On the other hand, there are higher growth expectations as depicted by the green bars, and this is associated to a risk-on scenario as shown in the gray bars. So we are adding things up rather than deducting things, and stock markets therefore go up. We have to be careful not to experience what we experienced last year. During 6 months, we spoke again and again about the trade war, which eventually did not have too big of an impact. The predominant story had to do with the huge investments that are now being made in technology and the international economic dynamism that we observe. So right now we are talking a great deal about the war, But the truth is that financial markets are not that much concerned or worried about the war. They are actually concerned with the fact that this economy is showing robustness. If we take into account the S&P or the S&P 500 index, we observe that cyclical securities are stronger than those that are not so uh, cyclical. And we also observe this with commodities. Of course, oil prices have been key, but if we take into account commodities, in some cases, commodity prices are higher than ever before. When we price this in, commodity prices are higher, and this happens. This is a widespread trend showing that the world economy is proven to be resilient. We should not lose sight of that because this is connected with inflationary pressure. And now let me refer to another inflationary risk. And again, I believe that this affects the world as a whole, not Chile specifically. And this is a medium-term structural fact. And let me go back to what Juan Jose already introduced. I think that we are also losing sight of what is truly important, what is actually transpiring in the world economy, apart from these huge technological changes and major investments that are taking place. We have lost the fiscal anchor fully. And I'm not talking about Chile here. I'm talking about the large countries in the world. I'm talking about a levelized rate of 5, 6, or 7%. So fiscal policy is no longer counter-cyclical. Fiscal policy is out of control. Every year we have fiscal pressure that cannot be tamed. And in general, we have observed this in developed economies as well as in some emerging economies, and this is having an impact on financial markets. But this is mainly concerned with developed economies. Now, these trajectories of fiscal pressure are prior to the outbreak of the war, all the announcements concerning defense expenditure in the United States or Europe. This war is being quite costly, and this war is also weakening those alliances that were in place for 60 or 70 years. As a result, when this happens, well, all countries are bound to spend more on defense, leading to huge fiscal expenditure. And this is a result of many other factors. So in the medium term, we are going to experience significant fiscal pressure, and central banks, on the one hand, will be the only remaining counter-cyclical tool because governments will no longer have counter-cyclical capacity. On the other hand, the credibility of these central banks will be increasingly challenged. Why? Well, because on the one hand, countries will have to accommodate higher expenditure and they will have to hike rates, or they will be under implicit pressure because they will have to issue so much debt that in order to control interest rates shooting through the roofs, they will have to increase these rates, affecting their monetary policy. I believe that this is our main inflationary risk, and central banks will have to look after their credibility, because unless we do so, the world will lack a counter-cyclical tool at all. Thank you very much, Elias. Thank you very much. You have shared a great idea. This is a cross-cutting effect with many results across the region, as Juan Jose mentioned when talking about Colombia. Let me therefore publicize our annual conference, or hosted with CAF on June the 5th. We're going to talk about the the vulnerability that we are facing in a highly fragmented world and the effects that this has on the monetary policies of the different countries. This is critical for micro and macro financial stability and the credibility of central banks. Now we're going to turn to Peru. Adrian, you have the floor. Okay, let me move on. I would like my presentation to be shown on the screen. Next slide, please. Well, inflation expectations after the supply shocks we described and which had reached 2% over that 12-month term reflected this shock coming from supply. However, inflation remains within the target. On the right-hand side, you can see the breakdown. We reviewed inflation expectations. These expectations are higher this year. As you can see, there has also been an increase in inflation expectations for 2027, but always within the median target. I would like to underscore that when we talk about inflation target in Peru, we refer to a range rather than a level. We talk about a target range, which stands at around 2% with a tolerance between 1 and 3%. The next slide shows how we are doing in terms of monetary policy interest rate. During this period, as I mentioned before, the monetary policy rate rose, reaching a maximum of 7 points and as inflation began to converge to the target range, this rate began to fall over the past few years. Against this landscape, when you have high inflation and high inflation expectations, we did not want to cut the rate abruptly, because based on experience, if you cut the rates abruptly, if the economy observes that these rates are not eased and they remain too low, increasing those rates afterwards would lead to even higher rises in order to recover credibility. Therefore, right now we stand at 4.25% in terms of the policy interest rate, with inflation standing at 7%. The estimated rate in Peru stands at 2%. For several months already, the actual rate stays at its natural level. Now, what happens with policy rates and expectations concerning the policy rates? This is a result of a poll. Prior to the shocks, markets expected that the rate would reach 4%. With inflation expectations standing at 2%, the actual rate being 2%, with a neutral rate, therefore, of 4%. After the shocks, markets observe, on average, a rate that will not fall to 4%, therefore, they expect a rate of about 4.25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25%. 25% In its latest release, the central bank accounted for this increase in inflation through a report. And this is very important. Here we're talking about communication, and that is a challenge that all central banks face. We have to explain to people that these shocks are only temporary. We have to make a very strong effort in explaining the reasons behind these shocks. And this is an effort the Central Bank of Peru has continued to make, as it announced during its latest report on monetary policy. And now I would like to stop here. Thank you. Thank you, Adrian. We have identified how heterogeneous our region is after you have explained what happens in Peru. Now we're going to move on with Mexico. Gabriel, you have the floor, and thus we are going to conclude the second round. Thank you. Let me share the presentation. In the particular case of Mexico, and talking about inflation estimates, as I mentioned during my first presentation, in Mexico, we have been faced by supply shocks and relative price shifts, all of these having some temporary effects on inflation. I also referred to special tax increases and the introduction of tariffs. This has had an interim effect on monthly inflation with a baseline effect lasting 12 months all in all. We have also experienced sharp price increases concerning agricultural products or fruit and vegetables. These shocks can be reversed relatively quickly. In the face of such supply shocks, and to the extent that the effects will begin to disappear, inflation will start to slide down. This is part of our central scenario going forward. Besides this, falling inflation would be underpinned by other key inflation components, such as the national currency value and FX performance. The Mexican peso has been significantly appreciated as of late. Last year, it appreciated by 13%, showing resilience over the past period in 2026. As for monetary policy, we have experienced some significant slowdown or deceleration over the past few years, with our economic activity being below our potential or historical average. As a result, we have estimated GDP at a negative figure. We believe that inflation will continue to decline within this time horizon, but we are facing risks. As for the upward risks, let me highlight trade policy disruptions arising from geopolitical developments. This is quite significant, taking into account the Middle East situation and the conflict between the United States and Iran. Therefore, our risks would include the fallout of these conflicts in that part of the world. But there are also some downward risks. And here I would like to highlight that maybe Mexico will report lower economic activity than initially anticipated. In Mexico, we experienced some economic downturn, and during the first quarter this year, we experienced a bigger economic contraction, more than expected. In our latest forecast concerning economic growth this year, we reported that the Mexican economy is supposed to grow 1.6% on average, the historical percentage being slightly above 2%. So we would actually be growing below the historical range. with a range between 1 and 1.2. However, taking into account economic performance in the first quarter of 2026, we will be reviewing our economic forecasts. In my personal opinion, it's highly likely that Mexico will grow perhaps below the lower end of this interval, with our economic expansion being below 1%. These are therefore the expected downward risks. Now, with regard to upward risks, let me highlight those stemming from the Middle East conflict. As we have already mentioned, this has made for a big disruption. In historical terms, we had never experienced such world supply disruption in the energy sector as we observe right now. As a result, there are some upward risks. Nonetheless, the direct effects have been limited in the case of Mexico, but there are some indirect effects. For example, inflation might go up internationally in the face of higher production and transportation costs, with some fallout effects in a country such as Mexico, which is an open economy. Then we have fertilizers. These could also affect foodstuff prices in the international arena. Let me highlight that given the farming schedules in the case of Mexico, should these effects be materialized, perhaps such effects would not occur right away, but we have to keep a close eye on it. In the particular case of Mexico, we expect inflation to slide down. This is our baseline scenario. We expect a negative GDP gap. We believe that some economic developments might contribute to such a scenario, but we also face other significant upward risks. And even though we observe risks on both sides of our balance sheet, in the particular case of Mexico, the risk balance sheet, it has an upward bias, therefore posing a challenge when it comes to managing our monetary policy. Thank you very much, Gabriel. To close the second round of questions, I would like to highlight again that there is significant heterogeneity across countries, but it seems that inflation is now behaving in a new way, with a balance of upward risks motivated by external factors in a more uncertain landscape that we have to keep watching going forward. We have to keep paying attention to the closure of the Strait of Hormuz and the impact that this could have on the prices of commodities, particularly oil prices, as well as how this could impact the financial channel, as Elias mentioned during his presentation. Then there is another aspect that is a cross-cutting aspect with different nuances. I'm talking about the monetary policy management, taking into account fiscal performance and or a fiscal performance that actually renders monetary policy management even more challenging in the different countries. And of course, managing expectations in this context is also quite difficult. Jessica has some questions ready for you from our audience, so please go ahead. Thank you, Carlos, and thank you all. Okay. We have a couple of questions considering the first part of today's presentation. Let me start with Elias. Elias, you talked about what has happened with inflation in Chile from a long-term standpoint and how external and internal factors have affected the trajectory of recent inflation. Elias also mentioned some global components where fiscal policy becomes a relevant risk. How this combination of internal and external factors might be exerting influence on inflation in the short term. What do you think about this? Okay. Our diagnostics should be prepared in two phases. First, we must identify the current scenario in the world economy, and in a second phase, we have to decide how countries will perform in such a situation. I believe that even though we are faced by these two sharp risks, or we have these two different scenarios, one in which the economy seems to be resilient with inflationary pressure, and another one where a counter-cyclical policy is required because the economy is falling. Well, over the past few weeks, we have observed that the conflict is lingering, supply shock effects are also sticky, and there are also some parts of the world where economic activity remains resilient. And this is critical for some large economies, particularly the United States. How does this affect us, or how does this affect other countries? Or how can countries grapple with these dynamics? In the particular case of Chile, we kicked off 2026 with an additional deterioration of the labor market. Even though activity and demand data so far do not point to a significant deviation compared to initial estimates. However, we believe that the labor market might be further deteriorated going forward. There is a co-integration with world dynamics I mentioned before. In Chile, copper production is a core activity, even though this is exogenous because core activity actually depends on the operation of mining sites. Mining evolution goes hand in hand with copper prices, and copper prices right now are relatively high. Even if the US dollar were low, investing in copper in Chile would still be beneficial. The same happens with energy. So we have some dynamic outlook in Chile. We have the so-called goods register, where all large investment projects are to be recorded, and which shows the outlook for the future. The latest report has shown a significant increase in activity. So we have this dual scenario. On the one hand, the economy is showing some signs of weakness, with households being affected by the war, but then we also see these investment expectations that, coupled with a resilient world economy scenario, might be beneficial. Eventually, we have to weigh both factors and just be ready to take action when the time comes. Thank you. I was thinking about that weighting that you have just mentioned. So, Gabriel, considering this weighting between internal and external shocks, and considering supply and demand and the effect that this can have on relative prices, could you elaborate further on how we can learn from past experiences and how this could help you determine the new trajectory of the inflation target going forward? In the case of internal and external factors, we must understand their interaction. In the particular case of Mexico, unlike in other economies, services inflation remained sticky, standing at 4.50%. One could assume that services which are non-tradable goods and which depend exclusively or to a large extent on domestic factors, that is in fact the case. However, external factors also play a role here. So let me refer to services inflation excluding foodstuff services. Foodstuff services account for about 20% of services all in all. And even though foodstuff services went down in line with a weaker economic activity, services remained at 8% last year. If we review the cost structure of foodstuff services, that just say restaurants, pubs, coffee shops, etc., they use intermediate inputs. So here there is a high correlation between foodstuff service inflation and goods inflation. Usually they move in the same direction. At the same time, in the case of Mexico, foodstuff inflation is very much correlated with the performance of commodity prices in the international context. So external factors such as international price performance concerning foodstuffs might be having an impact on those services which are considered to be non-tradable services or products. This shows the factors that could have an effect on inflation. It's not as simple as one might consider. There is an interaction between external and internal factors, and we must analyze all such factors and pay attention to their evolution. Thank you very much, Gabriel. Now, Juan Jose, you mentioned that one of the key risks that the central bank of your country has to do with the anchoring of inflation expectations. Could you please explain how indexing mechanisms had an impact on inflation stickiness and how this becomes a significant challenge for you when it comes to steering monetary policy going forward? There is a significant development that took place back in 2015, 2016 in Colombia. There were two shocks converging. On the one hand, oil price falls. At that time, the FX rate was sent through the roof. And that was coupled with the El Niño phenomenon. The central bank could keep the rates as they were, but afterwards the central bank hiked interest rates and inflation expectations converged quite quickly with a big shock because inflation reached about 8%, more or less. After 3 years, it went down to 3%. Just recently, we have observed a good management of inflation expectations. However, the measures that have been put in place are sending some complex signals. Why is it so? In Colombia, the monetary policy was affected by consecutive shocks, some of them being idiosyncratic and other global. For example, the global supply chain disruption coming from the war in Ukraine hit us hard. In 2021 and 2022, these rates were very high due to demonstrations in 2021 that eventually destroyed the economy's production capacity. And to cap it all, we experienced 25-30% Colombian peso depreciation as a result of such disruptions. So these consecutive shocks, and after the central bank hiked rates, when inflation was supposed to fall, well, what was it supposed to fall? Because fuel prices were not sustainable. When you begin to increase prices, well, that's not sustainable over time. Therefore, this faced several headwinds, and then we have minimum salary rises, which were quite persistent over the past 5 years. Which is our main concern. All such shocks actually prevent us from being far from our inflation expectations. Therefore, the problem here is that these BEIs might be distorted due to debt management related issues by the central government, and that's why we see these inflation rates remaining sticky. We don't know whether this is a market liquidity issue, whether this is a public and credit issue, or whether more inflation is supposed to take place with such debt issuance levels. There has been gradual credibility loss of the target inflation or inflation expectations. So this is our current position. I hope I have answered the question. Yes, of course. So in such a highly volatile landscape, some of these signs might be particularly noisy, and sometimes it prevents us from really distinguishing what should be taken into account for decision-making purposes. Adrian, very quickly, concerning monetary policy choices, you spoke about the potential actions that could be taken or that could be critical to manage monetary policy. I believe that you have learned some lessons. Well, how have these lessons affected the current policies? All central bank representatives here might remember that anchoring inflation in the long term has not been easy. This is a lengthy process, so earning a good reputation and credibility is something that takes a lot of work. It's not something that happens overnight, and the opposite also occurs. If you fail, credibility and reputation is something that one loses very quickly. So in the global inflation episode we all experienced, we should take into account that supply shock, or the supply shock might be big, but if we reach a certain level of inflation, people are no longer used to such levels. So central banks should regain control. Unless we regain control, or unless we have room for maneuvering or applying counter-cyclical measures, when we have anti-cyclical measures, that was because we had been able to anchor our inflation expectations. So the latest episode is a good reminder of all that. And we have to prioritize inflation anchoring. And once we regain control, then we can start doing some trade-offs. As for supply shocks, we can decide whether we need to take action or react or not. But inflation expectations need to be duly anchored first. Thank you. Well, we are in the very last mile of today's discussion. Thank you very much, Jessica. Okay, Now we're going to start with Elias. We're going to again have a forward-looking discussion. You spoke about external risk. Could you please elaborate further on such external risks? Is there any hierarchization going forward, which is the main external risk that might affect inflation convergence, taking into account global financial conditions, commodity prices, or geoeconomic fragmentation? Could you please identify this combination of external factors and how do we classify them into a hierarchy? Okay, let me go back to the narrative that is part of our monetary policy corridor that was published in March, which continues to apply to date. First off, oil stocks at sea are disappearing, so we are reaching a critical moment in this conflict. So I don't know whether this is going to last 2 more weeks or not, but should that be the case, we could see a nonlinear dynamics in oil prices. The market now looks forward to a quick solution, but should that not happen, commodity price shocks might be quite significant. So we need to analyze the implications they could have on medium-term inflation expectations. But this is not that self-evident anymore. We could have these significant supply shocks causing investments to go down, stock markets plummeting, which is not common, however, when big crises happen, and this might be offset by economic downturn or by growth considerably below the expected potential growth. So in that case, we do not know how inflation and pressure might evolve, but we might have to implement a counter-cyclical policy and cut rates. This might be a measure to be taken in the medium term. Albeit this is a potential scenario, I believe that we are closer to a more central scenario. Financial markets have priced in that this is going to be sorted out relatively quickly. Prices are not going to go back to 60, but they will fall, whether we talk about gas or oil, and the world economy will prove resilient. This is what main stock exchange indicators and commodity prices are showing. I find this scenario quite complex and we must be ready to react accordingly, because here we are talking about commodity prices which are not too high, but nonetheless they are much higher than at the end of last year. On the other hand, we see this world economy that remains robust. But if we have an opposite effect coming from the demand side, that will have a negative effect on inflation. We therefore should try to dispel this uncertainty narrative as soon as possible. It's true that this is a supply shock, but remember what happened during the post-pandemic. There was a supply shock on the one hand, but on the other hand, there was a demand shock in the background going on. So there are many things which are alike between both events, and I believe that we should take that into account. Thank you very much, Elias. We have to monitor and gauge, therefore, future developments carefully. Now we're going to talk about internal risks a bit more. In the case of the Colombian economy, Juan Jose, which are the critical factors that you observe in order to further consolidate disinflationary processes in coming years, whether we talk about fiscal dynamics, labor market, or domestic demand conditions in the Colombian economy? Well, that's a pretty good question. The answer is I don't know, to be honest. It's quite hard to say. If we take a look at our central scenario, the central bank staff has been concerned about public finance sustainability over time. If we take into account our central scenario, I would say that it's a little bit strange to some extent. The risk premium is growing. We estimate public debt to keep on growing. But we have no fiscal adjustment, no worsening of financial conditions. Therefore, this is kind of the same scenario with deficits which are relatively high. We continue to be financed, but capital markets are going to be there to give us a helping hand. So maybe that is the main shortcoming in terms of our scenario. Saying something different, like talking about a sudden stop or a default or a fiscal adjustment that should be huge, that's kind of far-fetched at this point, because right now we're not talking about this in the country. Especially in the current election period. So pressure comes not only from foreign exchange or financial conditions. We see some burnout symptoms. In the monetary policy report, we observe how the correlation of home prices is directly connected to monetary policies. So when you chart rates applied to houses and other rates, you see that there has been an increase since 2024, since the fiscal rule was broken, and since 2025 has been going up, even though the policy rate had been coming down. And I believe that these rates have gone or have surpassed policy rates, reaching 9% or 14%. So these policy rates reached between 9 to 14%. Over the past 2 months, we have observed that. There is a bigger correlation, therefore, with housing rates. The housing market is showing a very poor dynamics right now. And it has been persistently weak. This has nothing to do with interest rates, or this has to do with costs, with grants, with different aspects that have not been quite favorable. Nonetheless, we see some crowding out effects on in fiscal terms. This is the number one problem that we see in the Colombian economy, right in the background. And this has implications on monetary policy, showing some fiscal misalignments. Then we have labor costs or salary costs. Of course, all these matters make our life difficult. Nonetheless, I don't think that they are tied to a big macroeconomic factor. Nonetheless, increase in minimum salary also has a negative impact on public finance. So the context is rather complex. Salary increases, therefore, have an impact on macro variables. Okay, thank you very much, Juan Jose. Undoubtedly, this is a complex context, as Adrian and Gabriel pointed out. Central banks have earned themselves a reputation over the past decades, and that's their core asset and something that should remain unchanged. Let's move on to Gabriel. Gabriel, could you please touch upon the geopolitical shock and the pass-through mechanism? On the one hand, we have prices, and then we also have external demand, and this has a direct impact on the domestic economy. So how does the current geopolitical shock impact the domestic economy in terms of prices, logistic prices, or other factors that you described during your presentation? First off, let me refer to the direct effect that this shock has on energy prices in the international arena, the effect they have in Mexico. Up until now, this impact or effect has been limited due to some domestic policies put in place. In Mexico, authorities do not transfer all adjustments to the general public. I'm talking, for example, about fuel prices. Special taxes are adjusted rather to avoid that pass-through, and that way we can dampen the effect that international price volatility might have and avoid any oil price pass-through. That happened back in 2022 when international fuel prices skyrocketed as well. In Mexico, however, authorities took measures in order to keep prices relatively steady compared to other countries such as the United States, where such prices were increased significantly. There is market segmentation due to technological factors. We are affected by the United States, where prices have remained stable. But then we have Europe and Asia as well, where natural gas prices rose markedly. In Mexico, we have access to natural gas coming from the United States, which is the cheapest. We access that gas through gas pipelines. Therefore, direct impact was limited. As I mentioned before, there are some risks due to international foodstuff price increases or fertilizer price increases. When at the outbreak of the war, Mexico had already entered the spring-summer farming cycle, and therefore fertilizers had already been acquired. Therefore, the war did not have a direct impact for the time being. Nonetheless, this is a dormant risk. To the extent that inflation grows around the world, we might be affected at some point down the road. But then we also have risks on the other side of the balance sheet. If the war pans up, economic activity might be negatively affected, and therefore Mexico might experience lower external demand. So far, the Mexican economy has remained resilient due to booming investments in AI-related projects. This has certainly contributed to the U.S. economy's resilience as well. If energy prices and fuel prices remain high, that means that U.S. households will have less money to spend on other goods. And therefore, that will affect us because we are very much interconnected with the United States, and therefore we might be affected accordingly. There are therefore risks on both sides of this balance sheet. Thank you very much, Gabriel. In closing, let me move on to Adrian. Here we're going to talk about monetary policy implications in the current geopolitical uncertain context. We would like to know how the Central Bank of Peru is factoring in these risks as part of your monetary policy mechanisms and instruments. In the latest report published by the Central Bank of Peru in March, and after several years, we went back to an upward bias scenario. We thought that the conflict was going to be sorted out quickly, but today being May 11th, we still see that the conflict has not come to an end. Therefore, we have to monitor the different situations that might arise. For example, increasing fertilizer prices. The country will be affected in terms of its farming activity or the cost structure concerning production of foodstuffs, transportation. So we read more and more what could eventually happen. This is, however, a risk that is commonplace across the world economy. We need to factor in different scenarios, and we already did that back in 2021, 2022, taking into account not linearities. Sometimes forward-looking inflation might become more inertia-oriented. So from a calibration perspective, this becomes a growing challenge. The lesson learned, therefore, is that we have to communicate well, we have to explain what happens with inflation, and we have to monitor inflation, taking into account the supply shock, because this is unavoidable. But should prices go all the way out to 130, 140, I hope this will not happen, where we will have the challenge of explaining how these relative prices will hit CPI and prices at large. And of course, once we dispel the effects between supply and demand, well, we should try to go back to the target. We have run out of time, unfortunately. This discussion confirms that even though the region today represented by 4 central banks have been working on disinflationary processes, right now we are faced by a challenging context when it comes to steering monetary policy. By contrast with prior periods, supply shocks in the current context are having some special characteristics at a risk level, and in many cases this has a global and geopolitical effect as well. The credibility of central banks and expectation anchoring have been critical, and this is the main asset in order to tame these episodes. Today's discussion shows that monetary policy does not work in a vacuum. Rather, It's critical and it must be in line with other macroeconomic policies, including fiscal policies as well as financial policy. In a nutshell, we are entering a new inflation behavior stage where expectation anchoring and monetary policy will be critical due to the coexistence of some developments arising from both supply and demand. On behalf of FLAR and CAF, I would like to express our gratitude to our keynote panelists for their insights, as well as to the communications team of all the relevant institutions. We're also very grateful to all attendees, and we wish you a very nice rest of the week. Thank you very much. Thank you.